I think they dissent, but I think the Fed does not move. I think the Fed is going to be on hold through the rest of the year. The reason being that if you look at the inflation developments, even though patience is running thin amongst all on the committee, you are in this environment where you have some disinflationary currents that are likely to carry the way through the end of the year. Tariff pressures are past their peak. You're seeing there's still the effect, the pass-through of lower energy prices, even though we've seen this reacceleration in oil prices and gasoline prices, but there's still a disinflationary effect there. And then, very importantly, the labor market is not inflationary. Wage growth is still trending down towards 3.5%. That's not inflationary. That should not be a source of inflation going forward. There are risks, however, and I think that's very important to keep in mind. September, very much a live meeting, and the next meetings after that, October, November, and December, will also be live meetings. But I think the Fed will eventually end up on the side of not tightening monetary policy this year.
Do you think if we get those dissents that they compromise the leadership of the new Fed chair, or do they actually do him a little bit of a favour through the summer?
I think that's very important to keep in mind because during his testimony, 2 days of testimony, he said a lot, but very little in terms of his views on inflation, his views on monetary policy. He was cryptic at best. He did not say whether inflation was this number or that number, which for a Fed chair you would expect at least to express one view of a number, a gauge of inflation. He did not express any views as to whether he thought there was disinflation in the pipeline. He did not express any views as to whether the AI-led investment boom is inflationary in the short run. These are all topics that the Fed chair should be addressing. So I'm thinking that he's trying to hide in some ways behind the committee, and that even if the committee were to push for a rate hike in September, he might take that as a view of saying, well, actually, I was in favor of maintaining monetary policy, and I was not in favor of raising rates, but I did vote with the committee because that's the right thing to do.
Bill Dudley came out with a Bloomberg opinion piece where he said that the Fed should tighten at this point. He said there's little evidence that monetary policy is currently restrictive. Do you agree, particularly as evidenced by what we're seeing in capital markets?
I think you have to distinguish two things, right? You have to distinguish the real economy from capital markets. And when it comes to how tight monetary policy is, I think for some sectors, it is relatively strict. If you take us back to where we were back in March, before the onset of the conflict in the Middle East, you were seeing ongoing disinflationary pressures. We were heading towards that 2% target. So it wasn't as if there were inflationary pressures that were coming from strong demand and strong economic activity. When you look at capital markets, when you look at the equity market in particular, you are seeing a lot of forward momentum, which tells you that financial conditions are not restrictive. So I think you have to disentangle the two and depart from one view being tight for everything versus one view being tight for one thing versus the other.
The other aspect of Bill Dudley's point is that there's a credibility issue here for the Federal Reserve, that they can talk a big game, but if they don't execute some sort of action, then ultimately it will fall on deaf ears. Do you agree with that?
I agree with that. I mean, resolute commitment, as Chair Warsh said a few times, is not enough to convince everyone that there is the possibility of the Fed tightening. If you are really having that resolute commitment, you have to act upon your words. You can't just use words. And one paradox here is that Chair Warsh has been very critical of the prior Fed. He said that inflation has been a choice and that policy mistakes were part of the reason why we had a prolonged period of elevated inflation. If that is the case, then you have to act upon the higher inflation that you see, and you have to bring inflation back down towards 2% in a rather rapid way. The key question here is, does tightening help alleviate the demand-driven pressures? That's really the key question, because we have pressures from the supply side. The Fed can't really do much about the supply side pressures. Oil prices, tariffs, they can't do much about that. The key question is whether demand-driven inflation from AI is something the Fed can address. I don't think higher interest rates detracts hyperscalers from investing and continuing to put that upward pressure on inflation. But if you do raise rates, you tend to tamp down demand across other sectors, and that's where you can get some disinflationary pressures. But does the Fed want to sacrifice other sectors in the meantime while you're seeing a lot of investment in AI continuing to drive inflation? That's really a hard trade-off for a lot of policymakers.
Greg, it's good to see you. Always is. Thank you, sir. Greg Daco there of EY-Parthenon, looking ahead to that Fed decision a week or so away next Wednesday.